You walk into a bank and ask for a $500,000 mortgage. The bank looks at your income, your credit, your debt, the house you're trying to buy, and eventually, approved. Now there's $500,000 available to complete the purchase. So here's a question most people never think to ask. Where did that money come from? Did another customer deposit $500,000 that morning? Did somebody walk into a vault and pull out stacks of $100 bills? Did the Federal Reserve print another $500,000? Not exactly. Because one of the strangest things about modern money is that the institutions creating much of the money we actually use aren't printing dollar bills at all. They're commercial banks. And once you understand how that works, phrases like printing money start to mean something very different. First, we need to define money. Imagine you have $10,000 in your checking account. You probably say, I have $10,000. And you do. You can buy groceries with it, pay your mortgage, send it to someone, use your debit card, pay your taxes. But there probably aren't $100 bills sitting inside your bank with your name written on them. What you primarily have is a bank deposit. Your bank's records say it owes you $10,000. To you, that deposit is an asset. To the bank, it's a liability. And yet you use that bank deposit as money every single day. That's our first layer. Most of the money we interact with isn't physical currency. It's deposits recorded electronically inside the banking system. And those deposits can be created in a way that surprises people. Let's go back to the mortgage. Suppose a bank approves your $500,000 loan. One common misconception says, the bank first needs to find another person's $500,000 deposit and then hand that money to you. That's not generally how the accounting works. When a commercial bank makes a new loan, it can simultaneously create a new deposit. On one side of the bank's balance sheet appears an asset, your promise to repay the $500,000 loan. On the other side appears a liability, a $500,000 deposit. Loan, plus $500,000. Deposit, plus $500,000. The balance sheet expanded, and new deposit money has entered the banking system. No printing press, no suitcase of cash. No employee at the Federal Reserve had to type $500,000 specifically for your mortgage. The commercial bank created a deposit while creating the loan. That's not some secret loophole. That's part of how modern banking works. But wait. If banks can create money when they make loans, why can't a bank simply create $1 trillion tomorrow? Why bother checking your credit? Why charge interest? Why deny anyone a loan? Why do banks ever fail? Because banks create money is only half the story. Banks can create deposits. They cannot create everything they need to survive. And that's where the second kind of money enters the picture. Your money and a bank's money aren't quite the same thing. Imagine you bank with Bank A. The person selling you the house banks with Bank B. Your mortgage gets approved. The seller needs to receive $500,000. Bank A can create the deposit associated with your loan. But when that payment moves to another bank, Bank A may need to settle with Bank B. Banks settle payments using a special form of money, central bank reserves. Think of reserves as money that banks hold in accounts at the Federal Reserve. You and I generally don't have reserve accounts at the Fed. Commercial banks and certain other eligible institutions do. When money moves between banks, reserves can move between their Federal Reserve accounts as part of settlement. And here's the crucial difference. A commercial bank can create a bank deposit, but it cannot simply create Federal Reserve reserves whenever it wants. The Federal Reserve controls the supply of reserves in the banking system, so there are already multiple layers of dollars. Physical cash, commercial bank deposits, central bank reserves, all denominated in dollars. all connected, but not identical. So does the Fed create money too? Absolutely. The Federal Reserve can create central bank money. For example, when the Fed purchases securities, it can pay by crediting reserve balances in the banking system. Those reserves didn't have to be collected from taxpayers first. The Fed can create them electronically. That's one reason the phrase printing money can be misleading. Sometimes people are imagining giant machines producing piles of $100 bills. But modern monetary creation often happens through balance sheets. Numbers change. Assets change ownership. Reserve balances change. No physical printing press is required. Then, who actually prints the dollars? Here's another distinction. The Federal Reserve doesn't physically operate the printing presses that manufacture U.S. paper currency. Federal Reserve notes are produced by the Bureau of Engraving and Printing, which is part of the U.S. Treasury Department. Coins are produced by the United States Mint, also within Treasury. The Federal Reserve distributes currency through the banking system based on demand. So even the phrase, "the Fed prints money," compresses several completely different processes into 3 words. Treasury physically produces currency and coins. The Federal Reserve creates and manages central bank money and monetary conditions. Commercial banks create deposit money through lending and certain asset purchases. The monetary system isn't one printer, it's a network. Now here's where the old textbook story gets interesting. You may have learned something like this in school. Someone deposits $1,000. The bank keeps $100. It lends $900. Someone deposits that $900 somewhere else. That bank keeps a fraction and lends the rest. And the process repeats. That's the classic money multiplier explanation. It can be useful for understanding certain concepts historically, but it's a poor description of how modern U.S. banking operates if you take it literally. Since March 2020, the Federal Reserve's required reserve ratio on transaction deposits has been 0%. That does not mean banks have no constraints. And it definitely does not mean they can lend infinitely. It means the simplistic idea that every new loan is mechanically limited by a fixed 10% reserve requirement isn't how today's system works. Banks face other constraints that matter enormously. Constraint number 1, capital. A bank needs capital. Capital is essentially the cushion between the value of what a bank owns and what it owes. If borrowers stop repaying loans and the bank suffers losses, capital absorbs those losses. Regulators impose capital requirements precisely because a bank cannot safely expand its balance sheet forever. The riskier its assets become, the more important that cushion becomes. So a bank doesn't look at your mortgage application and ask, "Can we type $500,000 into a computer?" Technically, creating the deposit is the easy part. The real questions are, is this borrower likely to repay us? What happens to our capital position? Is this loan profitable? How much risk are we taking? Constraint number 2, liquidity. Remember our previous layer view. What would happen if everyone tried to withdraw their money tomorrow? This is where the 2 stories connect. A bank might have plenty of valuable assets, mortgages, business loans, treasury securities, and still need enough liquid resources to meet payments and withdrawals today. That's liquidity. Creating deposits creates obligations. Eventually, customers may transfer those deposits to another bank, withdraw cash, pay bills, buy assets. And the bank needs the ability to settle those obligations. A bank that ignores liquidity can get into serious trouble, even if many of its assets are valuable over the long term. Constraint number 3, borrowers. Banks need people and businesses worth lending to. Imagine a bank desperately wants to issue another $1 billion in loans. But every applicant walking through the door has no income, no collateral, terrible credit, and no realistic ability to repay. Creating those loans wouldn't make the bank rich. It could destroy the bank. A loan is an asset to the bank only because somebody is expected to repay it. Money creation through lending, therefore, comes attached to something incredibly important: debt. When a bank creates a loan, it isn't simply handing society free wealth. It's creating purchasing power today in exchange for a contractual claim on future payments. Constraint number 4: interest rates. Now the Federal Reserve comes back into the story. The Fed doesn't need to personally approve your mortgage to influence whether you get one. Monetary policy affects interest rates and broader financial conditions. When borrowing becomes expensive, fewer households want mortgages. Fewer businesses want loans. Some projects stop making financial sense. Credit creation can slow. When financial conditions become easier, borrowing can become more attractive. So the Fed can strongly influence the environment in which commercial banks create money, without personally creating every dollar of bank deposits itself. That's an important distinction. The Fed influences the price and conditions of money and credit. Commercial banks make millions of individual lending decisions inside that environment. And then something even stranger happens when you repay the loan. Remember how your mortgage created a loan and a corresponding deposit? Now imagine paying down the principal. When bank loan principal is repaid, the corresponding deposit money used for that payment is extinguished from the banking system's balance sheet. The bank's loan asset falls. Deposit money falls. In simplified terms, bank lending can create deposit money. Repaying bank loan principal can destroy deposit money. Interest is different. Interest becomes income to the bank, rather than simply reversing the original principal creation. So money isn't merely being printed and then sitting around forever. The supply of bank deposits is constantly being affected by lending, repayment, spending, asset purchases, government activity, Federal Reserve operations, and countless transactions moving through the economy. Money is much more dynamic than a pile of paper. Which brings us to a bigger question. If borrowing creates new purchasing power, what happens when an economy becomes increasingly dependent on debt? Mortgages, car loans, credit cards, corporate debt, government debt, student loans. Every one of those operates differently, and not every form of debt creates money in the same way. But credit has become deeply embedded in the way modern economies allocate purchasing power across time. You can consume today, using income you haven't earned yet. A business can build a factory today, using profits it hopes to earn tomorrow. A family can buy a house today, using decades of future income. Credit effectively pulls purchasing power across time, and when banks provide that credit, they can simultaneously create the deposits used to make those purchases possible. That's extraordinarily powerful. It can finance homes, businesses, innovation, infrastructure, economic growth. But badly allocated credit can also finance bubbles, speculation, and assets. Borrowers ultimately cannot afford. Money creation itself doesn't tell you whether wealth was created. That depends on what the money ultimately finances. So who creates money? Now we can finally answer the question. There isn't one money creator. The U.S. Treasury's Bureau of Engraving and Printing produces physical Federal Reserve notes, while the U.S. Mint produces coins. The Federal Reserve creates central bank reserves and manages the monetary foundation used by the banking system. And commercial banks can create new deposit money when they make loans or purchase certain assets from the non-bank public. Different institutions, different mechanisms, different kinds of money, all connected through the same monetary system. So when someone says they're printing money, the next question should be, who is they? And what kind of money are we talking about? Because the dollars in your wallet, the dollars displayed in your checking account, and the reserves your bank holds at the Federal Reserve. All say dollars. But underneath, they're different layers of the same system. And once you see those layers, money stops looking like something we simply earn and spend. It starts looking like what it really is: a network of promises, balance sheets, credit, institutions, and trust. And that's the layer view. If this helped you understand money a little differently, like the video, share your thoughts in the comments, and subscribe to Layer View for more. Stay curious, keep learning, and I'll see you in the next Layer View.